Well, stocks on Wall Street had their worst week of 2025 so far last week, as softer than expected US data sparked a little bit of concern over the state of the economy, which in turn saw the dollar trade to the downside for the third week in a row, and treasuries also advanced across the curve. The new trading week gets underway with German elections seeing a broadly market positive result as a relatively thin data docket awaits once more. There are developments in the geopolitical arena, and earnings from Nvidia are sure to give participants plenty to chew over. Without further ado, let's get into the show. Joining me, as always, to try and make sense of everything that's going on from Forex Live and Forex Analytics is my good friend Ryan Littlestone, who is doing his best Green Street impersonation this week after the football at the weekend.
Green Street impersonation, die hard, mate. I'm die hard. And I was, as we were saying just before the show started, your highlight of the season is being in a title challenge. My highlight is beating you lot 1-0 away.
Well, the title challenge is over. It's dead and buried. You won fair and square, and I'm going to go and cry myself to sleep for the next couple of weeks, I think.
Yeah, you've had a lot of sour grapes recently, haven't you? So you probably need a good lay down.
I have. It's one thing after another, isn't it? First the non-farm payroll sweepstake, then Arsenal shooting themselves in the foot. I don't know what's next at this point.
Well, be careful what you wish for.
Well, indeed. Maybe a new Barnet. That would do me a favour, at least.
No chance.
Sorry?
More chance of me growing a ponytail than you getting there.
Yeah, sadly there is, and I'm not flying off to Turkey anytime soon, that's for sure. Right, without further ado, let's get into Topical Thunder. Right, plenty for us to discuss. And of course, before we do so, just bear in mind that we are going to do something a little bit special next week. We're going to be doing a live version of the show because, believe it or not, Ryan and I next week will be our century of Trade Off UK episodes. I think well, I'm not sure how you've put up with me for that long, to be honest, mate, but we'll do something a bit different to celebrate, I'm sure.
I was going to say, I had hair when we started this show, and look at me now. So that's how I've dealt with you over the last 100 shows.
Well, so did I, surprisingly enough. In any case, if there is anything you want us to discuss in particular next week, then drop a comment down below and we'll make a note of it, and we will discuss it when we are live, and where, of course, anything can happen next Monday afternoon. In terms of this week, though, I want to kick things off not talking about tariffs, as it says on the right-hand side of the screen, but instead talking about the state of the US economy, because we've had a few bits and bobs out over the last week or so that have just put a bit of a dent in the idea of US economic exceptionalism. And I think there's a few caveats that we need to throw around when it comes to this data. But nonetheless, markets do seem to be taking a little bit more of a dour view of the UK economy, the US economy, than they have done over the last 6 months or so. In terms of those releases, the first was the retail sales figures that we had out, probably about 10 days or so ago now, with retail sales having fallen by almost 1% on a month-on-month basis in January. We then had last week some poorer than expected earnings from Walmart. And I think the reason markets have latched onto this is because Walmart are the largest US retailer in the country. They issued some relatively soft revenue and earnings guidance, and they also issued a warning that they're not going to be immune from tariffs if they do end up being imposed. So a few jitters coming from that. And then on Friday, we had dismal services PMI figures from S&P Global, their flash gauge in February falling to 49.7, which is a 25-month low. Although personally, I prefer to look at the ISM gauge. The S&P metric is perhaps a little bit more timely. And then about 15 minutes after that, we had absolutely dire consumer sentiment data from the University of Michigan, with that index falling to 64.7 from the preliminary read of 67.8, which itself was a pretty chunky decline from the 71.1 that we saw in January. Although again, take that with not a pinch, but a bucket full of salt, because thankfully the University of Michigan split that survey out among political leaning. Sentiment among Republican voters was unchanged at 86.7. Sentiment among Democrat voters was all the way down at 51.3 for a prior 65. So I don't think we can read too much into those figures. But nonetheless, the market is getting a little bit more concerned. Personally, I think it's way too early to be sounding the alarm bells about the state of the US economy. The labour market remains pretty tight, and you've got to remember that there's a lot of one-off factors that are skewing the figures at the moment. Certainly the January data, you had the usual round of seasonality issues, wildfires in California, you had that big snap of cold weather as well. But the market is certainly thinking that things are becoming a little bit more fragile. And we see the dollar trading lower for the third week in a row as a result of that. I'm going to talk a little bit more about the dollar index in a while, but we are trading at year-to-date lows. I would still, though, be a fan of buying the dip here, because I think even if economic momentum is waning in the United States, the US economy is clearly still going to be the best of a pretty ropey bunch when it comes to other DM and G10 economies. And one thing that did pique my attention when I was looking at a few charts over the weekend was if you dig into the option space, risk reversals on the dollar index, the Bloomberg dollar index, calls are trading at their biggest premium to puts in a couple of weeks. So there are some bulls lurking out there somewhere under the surface. We just need them to rise above the tide and break free a little bit, I think.
Yeah, I think we're in one of these situations with the dollar where it needs something extra to get it moving higher. Yes, we know the economy is doing okay. We're having a few little wobbles in some of the minor data points. I said last week on the show that PMI number was going to be important because it's first numbers after Trump's inauguration, just to get a little bit of insight, perhaps in business sentiment for his early policies. But yeah, when you get a market that can't rally, even when the news is still pretty good, you've got to take that as a warning. I think that's a warning for your dollar dip buying strategy. I don't think we're going to see an outright collapse, but when you're in a situation where you need something more to take it higher, i.e. much higher inflation rate, turning the Fed even more hawkish, then there is a risk that it goes the other way, because markets can only go two ways. So I think you've got to be a bit careful, because if you do start seeing the economy broadly weakening, we're seeing other numbers coming in much softer. It's not going to take much for the dollar to then tip over, because we're forecasting cuts in June, September, depending on what the market's like at the time. It won't take much before then we're thinking about earlier cuts from the Fed if the data starts tanking. So yeah, it's one of those, if it can't go up, then there's only one other way it usually goes.
Indeed, that is very true, and we will see what happens on that front. But yeah, I think for me, it's still a bit tough to be sat here and outright short the dollar, given the amount of uncertainty that lingers. But I do agree with you. It does feel as if the market, the dollar just kind of leaks lower if there's no news, and then rebounds when there is news. Yeah. So I guess if you are long at the dollar, it's really a bet on uncertainty remaining elevated, and the market, I think, has got a little bit complacent on the tariff front. We've had 3 or 4 times now where it's been a negotiating ploy, and you would imagine that at some point it's going to almost be the boy who cried wolf, where Trump is at some point going to actually impose these tariffs, and that might be a bit of a wake-up call.
Yeah, absolutely. And one thing I like to keep an eye on, as always, is what's happening in 10-year yields, because that's a good gauge of what's happening with the dollar. We've been pivoting around this 4.5% mark, and it really is a key level, where, as you can see from the chart there. And while we're below that level, it is going to keep the dollar on the back foot. And I think if we get down to sort of 4.34 and we're breaking that level, getting down to sort of 4.20s, then the dollar's really going to go with it. And that's going to mean the likes of euro dollar up through maybe 106 and higher, and cable up through 127, heading to 128. So I think you always need to keep an eye on yields, as we often say on this show, and I think there's some key levels coming up for this one.
Yeah, there absolutely is, and a couple of supportive factors for the long end last week. Actually, firstly, in the minutes from the January FOMC meeting, the committee talking about how they might need to slow or even pause quantitative tightening as a result of the ongoing debt limit shenanigans in the United States. And then about 18 hours after that, we had Treasury Secretary Scott Bessent, who was saying that the idea of terming out the US government debt, which is basically decreasing the amount of bills you're issuing and issuing more at the long end. He said that was still quite a long way off. So a little bit more of a supportive outlook at the longer end of the Treasury curve over the last few days or so. But we do have quite a lot of inflation figures out this week, which could be a bit of a spanner in the works for that theory.
Yeah, we got a slew of inflation data, and this stuff is coming out for February, so it's the new month on the blocks. It starts in Europe on Thursday. We get Spain, then we move to Japan, and we get the Tokyo CPI, which always comes before the national number, so it's a very important number, particularly for the Bank of Japan. Friday we get France, Italy, and the German numbers, starting with those regionals. Then we get the US PCE numbers as well, and that's going to be important because we had this higher CPI readings, higher PPI readings as well, but some of those components in the PPI that feed into PCE were lower. So it makes it maybe a bit of a coin toss for that one. Now, all these numbers are going to feed into expectations for the relevant central banks that are all going to be announcing in March. We're still in a market that's being pulled and pushed around by geopolitics. So these data points really just become small trading moments in time for trading and just reacting at the time. For the Fed, we're playing the calendar game, as I just mentioned, whether the next cut is sometime in the second half of the year. So this data will be important, as I say, if we see a broad downtrend developing that will cause the market to be priced those cuts sooner than expected. For the ECB, I've been saying it for a couple of weeks, they might be getting closer to a pause, especially given that some of the hawks and some other members like Holtzman are pushing back against further cuts. And that's after backing them so far. I think the Bank of Japan, though, is going to be the most interesting, as the data recently has really made a case for them to hike again sooner than the market has expected. And if that Tokyo CPI holds up, if it's strong again, those expectations are going to tighten even further. And that might mean we see further strength in dollar yen, which, is feeling the heat from that and also a bit from risk. And I've looked at the dollar yen chart here, and we've hit a really big level at the moment. It's the 50% retracement of the move up from the latter part of last year, around 149. And it's a bit of a doorway here. If we break under here, then we're probably heading down towards 157.
147, I hope.
147, sorry. I need my glasses on.
I was about to say that's brilliant analysis, but I might take that back now. But no, I do think you're right in terms of that dollar yen move, and I have no doubt that you'll be staying up late or getting up early for the Tokyo CPI figures when they're released on Friday. I think just taking a couple of things there. The big thing from the ECB. For me last week were comments from Isabel Schnabel. Holtzman is a hawk. He's always going to say hawkish stuff. We can ignore him. But Schnabel on the exec board actually saying, maybe the time is coming that we need to drop the label that policy is restrictive. We might need to start talking about pausing or even ending the easing cycle. Now, it's far from a consensus view among ECB policymakers that they need to wrap up the easing cycle in March when they get to 2.5%. But it is interesting that, effectively Lagarde's right-hand woman is coming out with that in an FT interview. And I think that could cause some relatively heated debate among members of the exec board and the governing council when they meet next Thursday, of course, the next ECB decision coming around thick and fast. In terms of the Fed, I don't think PCE is going to be a game changer this week, to be completely honest with you. The best case scenario for the Fed and for the market is that it does come in a little bit on the soft side. I think 2.6% is consensus on the core metric, which would be a 7-month low, if I remember rightly. But I don't think there's going to be enough in that data that's going to make policymakers look at it and go, we need to cut ASAP. They are firmly on hold. Although, again, just going back to those minutes, there was an interesting line that actually quite a few policymakers think or are of the belief that if you are getting hot inflation data in the first quarter of the year, that is likely to result in cooler inflation data in the remaining quarters of the year, because price hikes end up being kind of front loaded into the first 12 months of the year, first 3 months of the year, forgive me. So potentially we're going to see a situation again where the market gets max and aggressively hawkish and then has to come all the way back the other way.
Yeah, they didn't use that line transitory again, did they?
No, Governor Bailey's using that instead.
Oh, great. Oh, that's all we need.
Shall we have a chat about him?
Oh, if we must.
Oh, well, sadly we must, because it was quite a busy week here in the UK last week. We had plenty of economic figures out. But I guess before we get onto that, it's worth remembering that Dingra has been reappointed to the MPC for another 3-year term. The uber dovish member down on Threadneedle Street. She's going to be kicking around until 2028 now, which yeah, I'm not best pleased about that, but I know you like it because there's a little bit of vol and it gets us away from the groupthink. So yeah, fair play. In any case, onto that data that we had out last week. In terms of the figures that we had, the labour market report for December, of course, health warning. The figures are incredibly unreliable. Unemployment did hold steady at 4.4% in the last 3 months of the year, better than expected, although again, I'm not overly sure we can read too much into it. The big problem, though, is earnings growth, which is still running at about 6% on an annual basis. Clearly, that is way, way above where it needs to be compatible with the BOE's 2% inflation target. It's also the fastest annual pace of earnings growth since November of 2023. The inflation numbers, they have also started to move in the wrong direction. Once again, CPI at 3% on an annual basis in January, well above the bank's forecast. I guess maybe a slight silver lining was that services CPI was only 5% compared to their 5.1% forecast. But when you're celebrating that elevated a level of inflation, it's kind of sums it up, really, doesn't it, to be honest with you? I guess on the positive side, we did have better than expected retail sales. Sales rose by 1.7% on a month-on-month basis in January. But again, actually, that figure masked some underlying weakness, because what was propping that up was the decision by UK consumers to eat at home more rather than eating out. So it's more spending kind of shifting around the economy, and actually probably less spending, because it's obviously cheaper to cook yourself than get someone else to do it for you, as opposed to a sort of bullish sign for the UK consumer. We also had public borrowing figures, which they pointed to a surplus, but 5 billion quid less than expected, and also showed that we borrowed 10% more in the first 9 months of the financial year than the OBR had forecast. So another gold star to them for an excellent job. And then the flash PMIs for February, the manufacturing number falling to 46.4, which is pretty dismal. The services number did tick up to 51.1 from 50.8, but it left the composite gauge pretty much unchanged at 50.5. So what do we learn from all of that? Well, to be honest with you, not a lot. I think the story remains one where price pressures are still stubborn, they are still intense, and they are becoming more and more embedded within the UK economy. The labour market continues to loosen ever so gradually, but earnings pressures remain far too high, and economic momentum remains anemic at best, to be completely honest with you. So for me, it's still a stagflationary backdrop. For the second week running, we've got cable north of 126. And for the second week running, I'm sat here going, I still see absolutely nothing to like about the quid.
I'm going to take the other side of that slightly, because the data as a whole was better than expected, hotter than expected. Even if you take the jobs market, yes, we had better unemployment, and a lot of people have been expecting the jobs market to really start stuttering and showing some downside, and that's not happened. Inflation, we knew there were some skews in there from the month before, so no surprise to see the jump there. But I've been saying it for probably the best part of 2 years now, that inflation's always going to be more sticky in the UK than elsewhere. The PMIs, okay, yeah, services went up. That's the bulk of the economy. So, we pretty much ignore what happens in manufacturing. So overall, the data was a bit better. But I think it's a case of, if you're comparing it to the Eurozone and other countries, it's the least dirty shirt in the pile. And that might be enough just to give the pound a bit of support. We're certainly seeing it, as you said, in cable. We're seeing that a bit in euro sterling as well. So for now, we might just enter a little phase between these big data points for the UK, where if investors are looking around and where do they see a bit of improvement, it's going to be the UK over Europe, and that might see some inflows again.
Yeah, I think the technical term for that is scraping the barrel, but time will tell what happens on that front. In any case, moving on, it is, very sadly, actually 3 years today that the Russian invasion of Ukraine got underway. Sadly, things are still going on, but Ryan, is an end potentially in sight?
That's a big question indeed. It's hard to do a show without mentioning Trump or having him in a topic these days, and here we are dealing with another Trump moment. The UK situation, it's getting a bit messy again. 2 weeks ago, Trump stepping in and into the arena finally gave risk a bit of a boost. Finally someone was trying to take a stand or make a stand to end the war. Now it's looking like the US relationship with Ukraine is fracturing. We've had all those comments calling Zelensky a dictator and whatnot last week. The same is potentially happening with Europe. They got their nose put out of joint that they're not at the negotiating table. And the market might be seeing a bit too much concession being handed to Russia over this and what it might mean for Europe going forward and continuing to have to defend against that further down the line. Obviously, further defence costs are front and centre in those conversations, and that comes on top for Europe, on top of the billions that they've already piled into the Ukraine already. And remember, that's money that's coming thus far out of economies that aren't doing that well. They're struggling. And that all points moving forward to bigger budgets, lots more borrowing at a time when that's not what governments really want to be doing, or if they do, they want to do it to get their economies kick-started. So I think there's both long and short-term implications at the moment for the market to deal with over the days and weeks ahead. It's going to mean yet another subset of headlines that we're going to have to deal with trading-wise, the risk headlines that come out, and that's on top of the looming tariff deadlines and other headlines and everything else that's going on. I'm losing track of what we have to trade at the moment. Look at the elections in Germany. We've had to get over that hump as well, and that's been a bit of help for the euro. Now, before Trump took office, I did see the possibility of a huge risk rally if he helped end the war. And while I still think that's possible, that thought is slowly dwindling away just on the rhetoric that what we may have to go through first. As it stands now, I'm wondering if and how long the euro can keep itself up at these levels, given all that it faces in the interim. And we saw that today markedly on top of that German election news. Better than expected. Euro rallied, got up into big resistance, 105.30, above 105, couldn't hold it for more than 10 minutes, and then we come back down below it. So, I'm worrying for the euro, even if we do get a deal in Ukraine.
Well, I think worrying for the euro is probably an evergreen permanent position for both of us on this show. I think that the euro's reaction, just let's take the German election first. The reaction to that has been interesting. I think what's really happened is there's kind of two parts of the German election. It's Germany, so obviously it's complicated. The first is, what does the government look like? And on that front, we knew at 5 o'clock in the evening, UK time last night, it's probably going to be a grand coalition between the CDU and the CSU and the SPD, as it was, back in the Merkel days. And in terms of government formation, that was probably the most positive outcome. And that's why we saw that pop up to 105.30 during the Asian session. The question after that is, what can that government do? And I think the market's main concern on that front is, can the incoming government reform the debt brake? Now, for those of you who are unaware, the debt brake is a constitutional limit in Germany which prevents the deficit from running above, I think it's 0.35% of annual GDP. It's a very, very small number, whatever it may be. And effectively, the argument is, I think it's the right argument, that it prevents a lot of investment, it prevents borrowing to invest, it prevents borrowing to build, which in turn is holding back the German economy. Now, the issue is that in order to reform that part of the constitution, you need a 2/3 majority of members of the Bundestag, which is the lower house of the German parliament. So as the night wore on, it became increasingly clear that actually there is not going to be that number of MPs. There's going to be what's known as a blocking minority, which could make reforming that debt brake considerably more difficult. So I think that's why we've seen the euro come off the boil a little bit. And when I came in to film that half an hour ago, we were pretty much unchanged from where we closed up the week last Friday, because the market has kind of gone, great, we've got that certainty. We know there's not going to be months and months and months of to and fro on coalition negotiations. But then the market's kind of gone, but actually, we haven't quite got the certainty on the debt brake that we really wanted to get. And I think that's why we've seen a little bit of pressure on the euro. In terms of the geopolitical realm, I mean, trying to predict that is complete folly, to be honest with you. I mean, we've got about 4 or 5 different members of the Trump administration who are claiming to take charge of this, and they're saying 4 or 5 different things. So, when they're not singing from the same hymn sheet, it's very difficult to be able to trade that. And I think that's why we're seeing these choppy conditions, because market participants are subsequently finding it very, very difficult to discount a precise path as to where that's going to go. The one certainty among all of that, as you rightly alluded to, is we are going to see an increase in debt in defence spending across Europe. JD Vance, when he was speaking at the Munich Security Conference, was clear. We're not just going to be here to guarantee your security anymore, you lot. You've got to, man up effectively and defend yourselves. So how are European governments going to do that? Well, they're not going to tax more, because tax burdens are already ridiculously high. They're probably not going to cut spending and reallocate it to defence, because spending has been cut so much already. So it does lead you to borrowing. And I think that's one of the reasons why European government debt traded so soft last week, was because markets are now pricing in a higher risk premium and a higher degree of government borrowing, because the CDU and the CSU in Germany saying we want to spend 3% of GDP on defence. We've got Keir Starmer here in the UK saying that we're going to get to 2.5%, 3%, whatever it may be. There's only one way to get those funds, and that is to go to the market and borrow it. So, that is among all of this at the moment, the only certainties appear to be, and of course nothing's certain in markets, greater issuance from European governments and an absolute boon for defence stocks on the continent as well.
Yeah, absolutely. I said that this morning on my Flow show. You don't want to be short defence stocks at the moment. But you make the point, Germany talking about their debt break. And if they take the break off, they will want that to stimulate the economy. They don't want to have to use that to, build up their defence budget, because then that may bring some short-term production in German defence firms and everything, but it's not a long-term, it's not a long-lasting growth stimulus, if you like. So, yeah, and then after that, you still got to pay for it with growth. So it's a difficult situation. They're all going to be in the same boat, and that's why I'm not too keen on the euro at the moment, because if all that comes to pass, they're going to be paying for this, paying for peace for a long, long time to come.
Yeah, that's all going to get very, very messy, and we might have to do a show on that itself. But I think what will probably, for what it's worth, my base case is that the Germans set up a special defence fund which sits outside of the debt limit, and then reform the debt brake for domestic infrastructure investment, a classic EU style fudge, which we know they absolutely love to do. But I think the big issue is what you just alluded to. Does everyone just end up crowding each other out? Because if Germany are going, well, we want to spend this, France are going, we want to spend this, Spain want to spend this. So then you go, well, do you issue common Eurozone debt? And that takes you down a whole other path. And then you probably get the ECB to buy it, and that solves all your problems. But anyway, let's move on to our
very quickly. I wish I never started this topic now.
As you may have figured, I could probably talk about that all day, but I'm not allowed to. So what we are going to talk about again is the dollar. We talked about buying the dip in the dollar earlier on. We start a new trading week at a key level. Looking at the chart of the dollar index, we are sat pretty much right on the 100-day moving average, which comes in, around 106.50. As you can see here, I've marked on the chart inauguration day, which was, of course, the 20th of Jan. And the bias has been to the downside since then, and certainly last week when we broke towards the bottom of the 107.5 to 110 range that we'd been in pretty much since the middle of December last year. This 100-day moving average is of course, an absolutely pivotal level from a technical perspective. And in very similar fashion to Ryan's dollar-yen chart earlier on, if we do break below this level, then you may have some lingering support around the 106 mark, which was the lows that we saw in November. But below that, it's kind of a case of watch out below until the 200-day moving average, which doesn't come in until around 104.95. So the technical picture is looking a little bit soft. As I said earlier, the fundamental bull case is still a relatively strong one. But if we do see a closing break below this level, then might start to get a little bit more nervous. Ryan, we are looking at dollar MEX, I believe.
Yeah, because this week, and you briefly mentioned it, we might see the market switching back to trading these impending tariffs on Canada and Mexico. These ones related to immigration and drugs and whatnot that got punted early February to the end of February, beginning of March. Now, like most global deals, if an agreement is to be made, it's likely to be done at the 11th hour. So I'm looking at potentially shorting Dollar-MEX on any last minute wrangling on that deal making. That would mean seeing this pair rallying up to 2080, the 21 area, which is a level we've got up to through all the headlines. We've broken it, but we can't stay above that area, even with all these tariff threats. So it's a pivotal point again to see whether the market is really trading or has priced in the tariff threat. Now, I'm not going to play this with any big size, as there's the obvious risk that deals aren't done and we blow higher. But I think it's a pretty easy deal to get an agreement on, compared to the bigger trade issues that Trump's put forward and raised. And those also have an April deadline. So as long as any bad news is contained to that 50% retracement area around the 2080-21 mark, then I'm going to be happy to try a short on the hopes of a deal.
Good stuff. Well, we shall see what happens on that front. Certainly, excuse me, a story that has faded a little bit, and I would argue not much has really happened since the tariffs were kicked down the road. So, yeah, I'm sure we'll get a Truth Social post about that before too long. In any case, that does bring us to the end of another show. Thank you very much, as always, for watching, and to Ryan Littlestone from Forex Live and Forex Analytics. Ryan, I'm sure you'll smarten yourself up a little bit for our live episode next week. I certainly will be.
Yep.
If anyone does have anything they want to discuss, then do drop a comment below. Leave any questions or thoughts or charts or anything like that, and we'll get to them next week. In the meantime, thank you very much indeed for watching. Have a very good week ahead, and we will see you this time next week. Goodbye for now.